Welcome back to FT Markets. It's been a big week for monetary policy, with all the European Central Bank, the Bank of England, and the Federal Reserve in the US releasing the minutes of their monetary policy meetings. But while the central bankers have spoken, investors are yet not 100% sure of what they're going to do next. Discussing this with me today is Iain Stealey, Portfolio Manager at JPMorgan Asset Management. So Iain, let's have a look first of all at the Fed, which is what everyone seems to be obsessed about at the moment. So they were going to raise rates perhaps in September. Now people were looking at December, but it may not happen at all this year. Is that right?
Yes, it's been very interesting, hasn't it? Because they've actually been telling us all year they want to raise interest rates sometime during 2015. They've told us the US economy is strong enough to cope with that. And what we found in the last meeting is that actually they now are concerned with global factors, what's going on in the rest of the world, the strength of the dollar, and actually it could well be pushed out till next year. And market pricing currently not till June 2016 for the first full rate hike, which is a big shift from where we have been.
But one thing they're insisting on, and we know, is that when rates finally start to go up, they'll go up very slowly, and that's in a way what you got on your chart.
No, we can see that here, and that is definitely what we expect. That's what the Fed has told us. They think that the trajectory will be much slower than we've seen through previous cycles. They expect the terminal rate of the Fed funds to be lower than we've seen through previous cycles. So that should be all very supportive for fixed income investing.
Right. Now let's have a look at the other side of the Atlantic, which is what the ECB is up to. Now obviously the ECB in a way was probably hoping for a Fed hike, because that means cheaper euro and less work for them. But now it turns out that the Fed may wait, and that could force the ECB to have to do more in terms of quantitative easing compared to what they've already done this year with their 60 billion a month of asset purchases.
Yeah, so currently they're expecting to continue the 60 billion euros a month through to September of next year. But remember, at the last economic projections they put out, they brought down their inflation forecast for 2016 from 1.5% to 1.1%. Remember what the ECB's target is, it's at or just below 2%, so way below where they would like it to be. And that leads us to expect that they will have to increase their balance sheet past September 16 to actually get to a point when inflation expectations are in line with where they would like it to be on the long term.
And that's what you've got on your chart. How big do you expect their program to become if they decide to expand it?
I think it's going to be a matter of time, and obviously be very much data dependent and when the inflation expectations pick up. Our first thought would be that they would extend it rather than actually increase the size of it on a monthly basis. And I guess they would look to do it for a few months at a time and keep the market very much advised on what their plans are. And as I say, we expect maybe Q1 of 2016 for them to reiterate and expand on that further.
So what does this mean for investors? That's your third chart. And you're concentrating on high yield bonds in particular, and you think it's a good investment opportunity in many ways.
Definitely. I think if you look over the next 12 months, there's no reason when you look at the European high yield market that you won't get returns north of 5%. We have seen a bit of a backup in risk assets over the course of this summer. Obviously first with what went on in Greece, and then followed through with the concerns regarding China and the slowdown in the emerging economies. The European high yield market now yields you north of 5%. And this is in an environment when we've still got very accommodative ECB action. We have negative deposit rates in Europe. We have large volumes of the European government bond market trading with a negative yield. 5%, that looks pretty attractive to us. And the fundamental picture in Europe is decent. Europe is improving, and the overall economic projections are that the companies are in robust health.
Right, but final question, isn't there risk lurching out there? And some people are talking of a possible third crisis after the 2008 crisis, then the Eurozone crisis, now possibly an emerging market crisis. Obviously that would be a problem for anyone decided to take on further risk.
It'd be an issue for the emerging economies. The question then will be, will that transpire onto the developed markets? Because when we look at the developed markets, whether it's the US, the UK or Europe, they're looking okay. They're growing around about or slightly above trend at the moment. And we feel that although they won't be completely immune from what's going on in the emerging markets, they should be able to weather it. And actually what we're seeing is that Europe is doing okay, and it should be good for the European economy.
Well, thank you very much, Iain, for being with us today. So central bankers may be looking forward to an age of normalization, but it seems like investors will be looking at them for still quite some time.